Good morning, everyone. Welcome to the Fife Property Show this Saturday morning. We're going to be doing the buy-to-let tax update. Now, this, Jim, is really a no-nonsense guide, and we're going to go through current rates, allowances, and things. But I think the main thing is, and we spoke about this through the week, Jim, people are kind of uncertain and tax implications and things, especially for landlords and investors. And everybody just wonders, is it really worthwhile? Property investment and things, and tax is a big part of that. So we're going to cover that this morning. We are live. Please keep it interactive, guys. Jim's streaming on TikTok. He's streaming on Instagram as well, Jim.
Yeah.
Fire in questions. We will try and answer them. If they're relevant. If not, we'll do it at the end. But keep it interactive, guys. So tax, Jim, you want to give us a wee bit of...
Taxation's always been my thing because, I'm an accountant by trade anyway. I excelled in tax at college and my HND. I was, ended up getting a distinction in it. It's just so structural. It's so logical the way tax works. However, a lot of would-be investors and so-called, furus and gurus out there all go about banding about these numbers, about how much you can make in property. But the reality is, you've got to take into account tax as well. Yeah. Admittedly, I get people saying to me over the years when I've spoken to them about wealth creation even, oh, but is that going to affect my tax? And it's like, you're damn right it's going to affect your tax, because obviously if you're earning more money, you'll be paying more tax. Yeah. And it's like, it's a necessary, it's a necessary evil. Let's be honest. Because it's essential to make sure that you obviously pay your tax in order to help the system run. How that runs another story. That's political. But you need to have tax, and the government needs to raise tax in order to run the economy and run all the services. So just remember next time when you get squeezed for a bit more tax, there's a reason behind it. Yeah. Because it's to help other people. But less well off than you, more than likely.
Yeah, if there's changes in tax, or like you say, you feel like you're being squeezed for more tax, there's a reason for that, and it's obviously to benefit somebody else, obviously in the system. So yeah, and there is a bigger picture to tax, but we're not going to get into that.
It's a huge minefield. Tax is a huge minefield. You can have the simple, EDS, which is additional dwelling supplement, which is the 6% in Scotland, 4% in England.
That's one of the first things we're going to talk about.
3% that. So we'll all talk about that. But to the point of actually using LLPs to rebase your capital gains in order to transfer all your stock in your name over the 3-year period to a limited company with no tax implications at all.
Do you want to just clarify what LLPs are for people that aren't new to
limited liability partnerships? So that's another way. When you get to that stage, that's the wealthy, that's the super wealthy people that actually understand how to use that, and this is all tested at barrister level and Queen's Counsel level, QCs. So it's another way in order to mitigate your tax liability. We're not going to go into it in this because that's a bit in depth. But it's just to give you an example of the broad spectrum of the tax implications about how you could do things. Also using trusts as well. Another way to avoid inheritance tax later on by using a trust. Again, this is all specialist subjects. We'll not cover it here, but the things that we're going to cover here is basically stamp duty, and land tax, mortgage interest relief. A lot of people actually don't realise how mortgage interest relief actually works, and the deduction in your name, and also in a limited company partnership or a limited liability partnership as well. Income tax, capital gains tax, and corporation tax as well. So there has been a lot of changes to the way landlords are taxed over the years. Things like the wear and tear allowance, which nobody knows about because it's gone now.
It's gone now, yeah.
You used to get wear and tear allowance at 10% right off your top line if you were doing furnished properties. And hence the reason why I did furnished properties. And it was because it was a good lucrative tax break. And lo and behold, it's gone. What else? Capital allowances, which actually said you can get up to 60% capital allowances if you hold your properties for a period of time, is now gone. It's just a straightforward 18 and 28%. Again, we'll probably talk about this in a bit of detail later on. So these are all the things you've got to be aware of that no longer exist. Principal private residence relief, that's another one. It's like it still exists, but in a smaller state, in a smaller way it's done. These are all ones that you need to be aware of. We might touch on them, but I don't think we'll touch on them too much. We're going to stick to the main ones. So there's plenty of confusion, leaving some questioning whether buy-to-let is actually really worth the investment. Newsflash, folks, you're going to pay this tax regardless of what you're doing. So the reality is, whether you make money in buy-to-let or whether you make money in, another area as well, it's kind of, you're going to be nailed with the tax. The only things you need to be aware of in buy-to-let is the unique taxes which are there as buy-to-let taxes. That's what you're needing to be aware of. Some of the other stuff doesn't matter, really, like corporation tax, and we will cover it anyway, and capital gains tax, because they're pretty obvious. The answer is very much a personal choice if you want to continue to be in buy-to-let or worthwhile investment. And having a complete clarity is a great place to start when deciding on your future investments. Whether you're already in rental property or you're planning to buy or sell one, the changes in policy will affect all these different areas that we've talked about. So if you're completely unsure or sure of the latest rules and how to claim back your allowable expenses, this is for you, definitely. This is definitely for you. You should be tuning in. You should be getting out a notepad and pen. And if you're listening to me on our podcast, you should be getting out a notepad and pen now, because there's things here you'll want to remember, and you'll think, oh, I'll remember that. But you won't, more than likely, because if you're like me, you don't. It's a classic example is when you go to your bed at night and you wake up at 1 o'clock in the morning, you think, that's a great idea. I'll remember that in the morning. Bugger.
Yeah. That's,
in the morning and think, what was that idea again?
It's amazing how it just disappears, and you try to think, oh, it'll come back to me later on, but no.
So I actually get up at 1 o'clock in the morning or 3 o'clock in the morning and go and start and write down some notes before I go back to sleep again. Because that's how that's the time that you're probably the most creative, because there's nothing going on in your mind. And then what happens is you go into a dream state, and your dream state actually begins to work out your psychology and your mind, and get rid of all the knots and the nooks and crannies that were built up during the day and the stress. Yeah. And that's why you end up dreaming, to get rid of that. So if you don't dream, you've got problems.
I think, and in that state, I think you start to appreciate the power of your mind, and then you wake up and it's just white noise again. But but like you say, Jim, there's a lot to cover this morning. I think it's important that, although we've got this blog and you will be able to read that, what Jim and I speak about today, Jim will draw a lot of experience and things. So there's things on here that you could listen to and take notes for. So definitely do that. First, for me, I think, and I think a lot of people, is stamp duty and land tax is an important one, with the changes in that over the last year. And I mean, if you've already owned your home in the UK, you'll pay a supplement along with stamp duty whenever you buy another property. So it's your second home if you've already got an initial residence. Now, the extra costs are different from England and Scotland and Wales. Wales, not Wales. So make sure your budget correct whenever you're buying a property. Now, the additional rates are, for Scotland now, it used to be 4%. This changed, obviously, last year, just before the turn there, at 6%. So for any property over 40,000, you're going to pay an extra 6% on top if it's a second home purchase. So in England and Northern Ireland, it's 10%.
So we'll stop on Scotland now. What does that tell you straight away? For a purchase price over 40 grand. So if you're buying something, it's very rare to get something under 40 grand, but you can get it. So if you're buying something at 42,000, just put 2,500 or whatever as fixture and fittings included in the purchase price. Therefore, the price of the property is actually 39,500, and that will not have EDS on it, because fixtures.
A lot of people don't know that, Jim.
Isn't classed as part of that purchase. So if your owner wants a bit, your seller wants a wee bit more than the 40,000, and you're like, I can't do that because of this. Just fixtures and fittings, it's fine. The tax is okay with that. They're fine with that. It can't be 10,000 out of 40,000, by the way, unless you've got a summer lodge out the back.
Yeah,
like a summer lodge, a log cabin or something like that. Fair enough. You could class it as that, because that isn't part of the actual land and buildings.
Yes.
Because remember, it's a land and building transaction tax. It's not a land and buildings lodge transaction tax or anything like that. So if you want a wee bit extra for that, then do that. So there is chances. But then if you buy for under £40,000, then you're going to have a problem trying to remortgage that.
Yeah, it's going to have to more or likely be cash.
It'll have to be cash. Because there's no
mortgages are usually about the 50 grand mark.
There's no mortgage lender out there that will do that. So that's the problem with this. They don't want to do anything over that. I experienced this when I first started out. I think it was 30,000 or less. So if you had a property that you were buying for less than £30,000, I mean, I was buying about 9 and 10 grand.
Yeah.
And 12 grand for a 3-bedroom flat. So the reality was there was no way I was ever going to get a mortgage. So I had to go to a corporate lender straight away, like the Bank of Scotland. It was the Bank of Scotland, actually. And they then gave me a facility, and they allowed me to buy on the facility itself. And a facility means we're going to give you up to 100,000, fill your boots. Once you've done that on an overdraft, then we'll just transfer the overdraft into a term loan over a period of 20 years. And that's the terms of the term loan. So that's how I did it in the very beginning. There is other ways to do this as well, as potentially a bridging loan. Mm-hmm. So you potentially, if there's a lot of value in there and you're getting it really below the market value of the £40,000, then you could essentially bridge it for that period of time. So bridging companies, the ones that exist now, love the fact that they can take security on the property. They know what you're doing. You have to have a track record. You can't just go to a bridger and go, okay, I just feel like doing this. It sounds like a great idea, and you've got no coherent strategy about how you're going to do anything. It's just like anybody. You've got to have a wee sort of a mini business plan about where this is going, what you're doing, and what you're expecting to get out of this. If they are convinced of that, then they'll bridge it for that 6-month period. It might be shorter than that, depending on what lender will come in after that and mortgage the property for you. So if you're not, there's a classic of using bridger loans. You're maybe not going to be able to purchase the property without the bridger. Mm-hmm. So you're better having 50% of something than 100% of nothing.
Nothing, yeah.
Yeah. So that's what it is. So I mean, they take a fair whack, but if you're going to have nothing anyway, and potentially if you've got a 40 grand and you could make 60 grand when you remortgage it, then the bridger might be a great idea. Because when you get the mortgage out, you can pay the bridger off, you can pay and then you've got the property. You wouldn't have had it otherwise. And then over the long term, the 15 to 20 years, it appreciates in capital and provides you with an income to reinvest back into the property and other properties round about it. So that's the point of the 40,000, the over the 40,000 for the 6% EDS. But if you buy under 40,000 or under 50,000, and it works out with the numbers, again, it's all about the numbers. If it works out with the numbers, then you can potentially get them involved, or you could potentially get someone else involved, like one of your family and friends. Because that isn't covered by the FCA.
Joint venture, yeah.
That's not covered by FCA. So because it's family and friends, if you're going to the public, the general public, then that is covered by the FCA. There's specific rules that cover that, and you could be held to account and liable and potentially prosecuted for criminal liability. So you've got to be aware of that as well, I would say.
Yeah, just to sidestep slightly on the bridging side of things. Bridging isn't something that you've ever really used, Jim, but as you just demonstrated there, it is maybe the right choice for somebody in the right situation.
I'll give you an example of how I have bridged.
Right, I know you have used it, but it's not something predominantly.
I've used some of my other companies to provide the funding.
Yeah, to leverage your position.
Yeah, to allow that to happen, and then when I went to get the mortgage on it, then I would get the mortgage, get the money back out, and then pay the money back to my other company. So I've become my own bridger. It's an easy way to do it. So I've become my own bridger by using my own finance from other areas. And you can do that. You can even create your own sort of bank. I mean, in the early days, Kevin Green, Secret Millionaire, Kevin Green actually taught me to do that. You can have your own bank and loan money to yourself at rates, and then actually pay that back. And actually, it's a good tax efficient way to do things.
Yeah. Yeah, good. Marcus is saying a bridge, and then later on buy to let. He's saying he bought for 39.95, and then 6 months later remortgaged for 64 once. So yeah, so there you go.
I'd be nervous about buying for 39.995 because immediately you flag yourself up in the system with the HMRC and go, let's have a quick look at that, because that seems a bit suspicious. It's just £5 below. That's why I said £500 below.
Yeah.
For that reason. But if you've not got any fixtures above that, then Marcus, and you've bought it for that, then that's fine. But if you do the fixtures thing, make sure it's a wee bit below because it's pretty obvious what you're doing. And if they just go, oh, that we'll single that one out.
They might pick you out. Yeah.
Yeah. What was these fixtures? There was an old cooker left.
Yeah. I mean, it can be done, but yeah, so it was a bit below, you say. But anyway, so the 6% in Scotland, yeah. In England and Northern Ireland, it's 3%. In Wales, it's 4% on any purchase. Now, there is ways and means, and you just obviously pointed out there, Jim, that we could do the fixtures and certain things. But what about multiple property purchase as well? Because that is one way to get around the stamp duty. And we done this last year. Did we do this a couple of times? Did you do this a couple of times?
I've been nailed for multiple dwellings relief, and it does come into play. I'm buying 30 just now, all at once.
Mm-hmm.
And my multiple dwellings relief bill will be £20,000. Yeah, and that's okay with me. I mean, I have it now factored into it. But if you took the ADS and just had the ADS still in existence, I know it's over 6 properties, and I thought, yeah, I'm not paying an ADS. And then multiple dwellings relief came in, it's 20 grand. But ADS is 114,000.
Mm-hmm.
So I'd rather pay the multiple dwellings relief than that. So multiple dwellings relief is a different thing. It's a commercial thing. And this is when you're buying a huge substantial portfolio, it's viewed as a commercial transaction rather than a residential transaction. And that's why MDR actually comes into play. So if you're buying 2 to 5 residential properties in one transaction, it may qualify for the MDR. But you've got to check with your solicitor. Alternatively, buying 6 or more homes, mixed-use property like shops or flats above can attract cheaper non-residential rates. Exactly what I'm talking about now. If I did MDR on residential, my bill was going to be something like £78,000. But because it's classed as commercial, even though it's residential properties, it's 20 grand.
So there's 20. Yeah.
There's difference depending on where you're looking at to expand. So if you're unsure about that and you want a bit more detail, then I would actually speak to an accountant on it.
Yeah.
So speak to an accountant, but also speak to your solicitor and get 1 or 2 opinions. When I went to the solicitor in the beginning, the solicitor said it was 78 grand, and I went, "Are you sure?" And I went to another solicitor and said to them, and they went, "No, it's 20 grand because it's a commercial transaction." And then I went back to the other solicitor and said, "Is this not a commercial transaction?" And they went, "Oh, you're right." It's like
so if you hadn't questioned that,
if I hadn't questioned that, I would have had to pay £78,000 completely unaware that could have been that was the case, and no one would have been any different. And no, the HMRC wouldn't have gone, "Oh, you've overpaid us by 50 odd £1,000. They never would have done that because that's no like the HMRC just don't do that. So if I hadn't questioned that and I hadn't checked with another source, then I would never have known that. So, I take my hat off to the people I use, but I use specific people because I can trust them. But I do use 1 or 2 to make sure I can bounce one off against the other to make sure they're both singing on the same sheet. Now, the reason I do that is because in accountancy, when I was an accountant, there was differences of opinions about how the law was interpreted in terms of tax and what was allowable and what wasn't allowable. And it's all down to sometimes case law. Now, case law sets precedents in terms of taxation policy. So even though the rules say one thing, you could actually get them interpreted another way, which is applicable to you, which means that you might not have to play by these rules in taxation. Hence the reason why I talk about conversion of LLP, rebasing the capital gain assets, in order to mitigate your capital gain liability and rebase it and class it as what is effectively your capital gain would end up being a loan from you to the company.
Yeah.
And you have no liability to HMRC. That's how the wealthy avoid taxes.
Yeah.
Now, tax avoidance is perfectly legal, remember. This is using the legislation.
As long as it's done correctly.
Yeah, it's tax evasion. It's criminal.
Yeah, and there's a big difference in that, obviously.
A couple of questions. Somebody actually said, any experience of buy-to-let in Spain? Yes, I did buy in Spain. However, I didn't let it. I ended up changing my mind and using it as my own home. It's like I bought it and I thought, there's no way I'm renting this. And I've had it for about 20 years. So Just a wee bit more. Have you any properties impacted by the cladding scandal? Do you have any properties impacted by cladding scandal? No, is the answer to that.
Do you have any properties in what? Sorry.
Impacted by the cladding scandal?
Right, okay.
No, because I don't buy properties like that. I make sure I do my due diligence, and I don't buy anything that's going to be risky. I'm not a risk person. I'm pretty risk adverse. Although you'll see a podcast that I did a few years ago called Monte Carlo or Bust. And that's all about but then
it used to be a motto.
That's what I've always, but it is still my motto.
It is, yeah.
And then I do have a look. I have a Wall Street bull here because I'm effectively an optimist and going for it all the time. So I actually keep that as my wee motto, and the fact that I'm bullish about everything. I can see opportunity every single time, even when people see pessimism and no opportunity at all. I could see the opportunity. I could. It's just one of these things you become. You almost program your brain to see every single time. So as soon as something pessimistic comes up, I go, "There's the opportunity right in front of me."
That's it's a really good, and we'll not get too into wealth creation kind of show stuff, but that's a really good mindset to be in. I think I spoke to you the other day about how easy it is for even myself just to slip into that kind of pessimistic approach to things. So yeah, it's good to keep yourself in that positive mindset. But
mortgage interest relief.
Yes,
let's talk about that. Yeah.
So yeah, for landlords with no mortgage, and there is a lot of them. The recent changes to mortgage interest relief will make no difference to their monthly income.
Yeah.
So, however, if you do have a mortgage on your rental property, the policy changes that begun in 2020 and the budget have now reached their final phasing.
Section 24 of the Finance Act.
Yeah. So private landlords could previously claim all of their mortgage interest as an expense, but they have now changed to a flat rate of 20%.
So how does that work? Let me tell you how that works.
Okay.
So normally in accountancy rules, in accountancy land, what happens is your sales minus your costs minus your mortgage interest brings out your profit. What they're doing now, and your profit is what you're taxed on, okay? What they're doing now is the sales minus your costs, your profit, you're taxed on, then you get 20% credit to take off of your mortgage interest.
Right.
Okay? So mortgage interest has no bearing anymore on your profit anymore. So in other words, you can see if you've got £70,000 of mortgage interest, you have to earn about £70,000 just to break even.
Mm-hmm.
Or you'll no break even. So you've got £70,000, you've got to earn £70,000 in profit to break even. So you'll be taxed in the new rules on the £70,000 in profit. So you'll be a higher rate payer straight away. Under the old system, you were earning zero profit, so you wouldn't be taxed on anything. And then you're given under the new system, you're given the 20% taking off. So some of that of £70,000 will fall into the higher rate tax bracket, but you're only getting 20% of that off instead of 40%. Therefore, that 20% you'll be left paying. This is how, when I was used as a test case for the Treasury Select Committee. Roger Mullen and I got together, and Roger was on the committee, and he took it as an example. Because when it was first announced, I think it was in 2016, I then worked out my tax position if I actually broke even, and it actually meant that I was going to pay £5,000 in tax, even though I wasn't making any money. And this was meant to affect 1 in 4 landlords. So we thought this was a problem, and Roger took it to the Treasury Select Committee and says, "Look, I've got a landlord here, case study. We want you to look at this in 6 months' time to see how it's affected some landlords, the 1 in 4. And the Treasury Select Committee said, "Yeah, it's what it is. We're no bothered." But it highlighted at that time the inequality in the taxation system and how we've been segregated for that, and vilified and pinpointed and picked on as a way to raise more money for the exchequer. And to get more money in, just by changing it for us. Now, this thing about, it's fair because normal homeowners don't, they don't get a deduction from their income against their mortgage interest. And it's like, but they're not running a business.
Yeah, I was just going to say they're not running a business. Yeah.
But the European Court of Human Rights, or whatever it was, when they took it as a test case, said, "No, well, you're absolutely right. It stands." It's like, really?
Yeah.
Wow. And it's the first time in history that accountancy rules have been actually turned on their head and completely ignored, where, sales minus costs equal profit. It's no longer the case when it comes to buy-to-let. Only if it's in your name, your
That was the next
name,
question.
and you have a mortgage.
Yeah. So the next question was, what about a limited company and mortgage rates and things? So if you've got a limited company, can you still claim back the mortgage interest as an allowable expense?
Yes.
Yeah.
And the reason that they've left limited companies out, and this is an assumption, but I know this. The reason that they've left limited companies out is because if you affect limited companies with a mortgage interest, then the ramifications for all limited companies in Britain, PLCs as well, would be horrendous. It would affect them as well. So you've got have nothing to do with property, or they've maybe got their property and they use it to run their business from. Take an example like Fife Properties. We own our own properties and we rent our properties to ourselves. Therefore, but we pay mortgage interest on it as well. Therefore, that mortgage interest would not be deductible under the rules, and that would just throw the whole system into chaos. That would bring our economy to almost a grinding halt in terms of businesses. So that's why it didn't affect limited companies, and that's why a lot of people are actually wanted to change the limited companies later on. I've got a question there. So if you have a mortgage, if your mortgage is 100,000, you get 20k tax free. No, it's not based on your mortgage. It's based on your mortgage interest. So if your mortgage is 100,000, and we'll say for the sake it's 10% interest rate you're paying on it, you're literally 100,000, 10% interest on it. You're £10,000 a year in interest you're paying on that mortgage. You'll get 20% of that £10,000 as a deduction. So in other words, £2,000. But what happens is, if it's in your name, that £10,000 can't come off your costs. It has to come off as a tax credit at the end after your profit's calculated and your tax on your profit. So if your profit is £50,000 and your tax, for example, is, your tax is on £50,000, and make it easy, say 20% of 50,000 is actually, it wouldn't be, it'd be about 20% of 40,000, because you'd have an allowance. So we'll just say 20% of 40,000, and then the next 10,000 would be taxed at 40%. So you see how that is. So you've got a 10,000 taxed at 40% there. So you're paying 20,000. You're paying 20% more in tax on that extra 10,000, but you're only getting 20% of that 40 off. So you actually end up paying £2,000 extra in tax because it's in your name, if it's like that. So hopefully that's explained it. I know it's no easy to explain it, but if you look at our playlist on our wealth creation show, I actually go through that in a bit of detail, because we do have a show specifically on tax and how that affects people.
I've actually, as we come to talk, if you look through the blog that will be attached to this, I've actually put the link to our landlord tax tips blog that we've done previously, and it'll have the show and everything. Yeah, so
landlord tax tips on our Facebook page on this one that's running. Unfortunately for TikTok, we can't do that because it's limited about the amount of information you can put in there. So the landlord tax tips is on our blog, which is on our YouTube channel. It's streaming right now in our playlist for the weekly property shows. So you'll see that right now, and it's called the show is actually called Buy-to-Let Tax Updates: The No Nonsense Guide to Current Rates and Allowances. So he said, if you've got one buy-to-let, is it more cost effective to set up a limited company or not? It all depends on your personal circumstances, and it's not something that I could answer just by a yes or no answer. Because if you're a higher rate payer, it might be advantageous. If you're just a basic rate payer and this doesn't push you into the basic rate, then it probably won't be advantageous. If you're paying the same interest rate for your for your mortgage, which is more than likely what it is now. Limited companies and sole traders are same interest rate levels nowadays. The mortgage companies don't distinguish. So if you're in your own name and you're more or less paying the same rate and you're not a high rate payer, and this won't push you into high rate payer territory, then the answer to that is probably just stick with where you are. But if your plan is to build it for the future, then you probably want to put it in a limited company now and actually do that. But there's additional costs involved with a limited company. It's the year-end accounts.
Yeah, I was just going to say that, Mark, and I think that will answer Marcus's question as well, because he said, so would you advise to move to my personal buy-to-let to my company, so the company owns it as an asset? Or
The problem is moving it to a limited company now means you've got to pay 6% EDS.
Yeah, you'll pay the tax on that.
I quite cleverly was able to move 6 at a time, so I didn't pay EDS, and I also bought sometimes, I moved 3, and then I bought maybe 3 from the open market, and I got them to transact all at the same time. So I didn't need to pay EDS when I transferred the 3 in my own name to the limited company.
Yeah.
Plus the fact you had generous allowances like 12,500 in capital gains tax, which we're going to talk about. Previously, it's now been reduced to 6, and it will now be reduced to 3, I think, next year. So they're all disappearing as well. So it's almost coming to the point where it's no worth putting it in your name anymore. It's probably just better just putting a limited company. But the government wants you to do that because it's easily traceable for them, and there's no doubt about hiding anything. Because you can still easily hide stuff in your own name. If you're savvy enough, you could do that. I don't care what anybody says, because the people that truly money launder are not following the money launder rules. Newsflash, in case anybody didn't realise that, the people that truly money launder aren't following the money launder rules. What? They have to follow the rules. They're criminals. They don't care about the rules.
Yeah.
It's like amazing how people actually think they'll follow the rules and we'll catch them. No, we won't. So my advice in a nutshell for this is speak to an accountant about your personal position and explain everywhere where you are right now, what you expect to be earning, and they'll be able to advise you what different scenarios will cost you in tax of where you are right now if you've got a limited company or you run it in your own name, and how much tax you would pay each time. Classic is if you're earning 33,000 a year. I said that because that's the average salary. If you're earning 33,000 a year, then and you've got your buy-to-let position, 33,000 a year you're earning, buy-to-let position in your own name and in a limited company, work out the tax in 2 scenarios, and then decide. That's an easy way to do it, because your 33,000 is no changed. It's just your limited company and your sole trader. So you're just taking it in isolation and saying which one would be best in taxation principles if I worked out the 2 scenarios. And if the limited company comes out better, it's like, that's the one to go for. If the sole trader comes out better, that's more than likely the one to go for. But that's in an ideal world. Circumstances change. You get a higher paid job, you get a lower paid job. You can't afford to have your buy-to-let anymore. You have to offload it and sell it. They're all different things that you have to think about for the future if this is what you're wanting to do. My principle is I'm holding it till I die, and then it passes to my children. Yeah. Well, I'll pass to my children before I die. And so that's my scenario, and that's how I plan everything in terms of that.
Mary said there exactly why I'm about to sell up after 20 years. Mary, it'd be interesting to hear what your actual story is. If you could reach out, maybe we could give you some advice, point in the right direction, depending on what your circumstances are. But
how much do you say you have to save up to buy your first house to let? 100,000 house? Nothing. Absolutely nothing. You could buy £100,000 with nothing. Work that one out.
It can be done. Yeah.
That's another story. It does exist. You can be quite creative in actually buying £100,000 house with nothing. You don't need to save anything up at all. But that's another show, and in its entirety, that's a huge thing. And that involves things like bridging companies as well. That can be done that way. How much does it cost to run a limited company annually for accounts? I think a couple of £100. If you do all the donkey work, here's the answer to this. If you do all the donkey work in your accounts, in other words, do your day-to-day stuff, it's easy to do that, because if you run everything through your bank account, all the transactions through your bank account, and you don't involve yourself in cash, you just use your switch card or your debit card every single time, then everything's traceable through your bank account. So it's easy for an accountant to look at your bank accounts, for that. And don't mix it up with your own personal bank account. Get a separate bank account. and then you've got everything, all your transactions in there. You've got your rent coming in, you've got your costs going out all the way through. So it's easy to put that in a spreadsheet. And most banks actually download it in a CSV file, which can be put on a spreadsheet. So you can just sort it out at the end of the year. Then you sort it out. You've got, there's my income, there's my outgoings, there's the finance, there's the maintenance, there's the charges. There's separate categories for the Schedule A return. And you put them on to these individual categories. HMRC tell you what falls in each category, and then you just present that to your accountant, and your accountant goes, great, I'll just file the company accounts. That's it. £200. Easy to do. And then they do your tax as well for you at the same time. That's probably what it costs.
I think a lot of people feel a bit feel like that's a daunting process, and why a lot of people leave it to the last minute. But really, if you keep yourself right throughout the year, it's a fairly simple,
it's an easy,
like you say, present it to your accountant and let them
easy guide. If anybody wants a wee refresher about that, I'm happy to do that on some show later on. If there's a mass demand for it, we'll do it.
Yeah.
Okay.
But yeah, so the changes in mortgage interest rate, interest relief, make it even more important than ever that your property's income and its occupancy rates are at peak performance, and that's something that's always at the forefront for me as a letting agent and managing properties and things. Is the credit control rate and the occupancy rate are so important, key elements of having a successful buy-to-let and portfolio. So, like I say, guys, feel free to reach out to me and speak to me if any of you have an issue with these kind of elements of your buy-to-let portfolio, and that is having a detrimental effect to you, i.e., Mary, like you say, exactly why you're selling up after 20 years. Feel free to reach out to myself.
And then that brings income tax. So just like a regular job, you pay income tax on rental property you receive, on the rental income you receive, but there's some differences in how you pay it and how you can reduce your bill. Now, as a landlord, you only pay tax on your net rental income, which means the total income minus any allowable expenses. And you can actually find tips galore on here on our previous landlord tax tips. We've got a link on this for the people on TikTok and Instagram. Actually, you won't have this link. So again, go to our YouTube channel and look up the income tax updates, and the one that we've just done today. So this is literally the income tax updates today.
And you say there, Jim, as well. Sorry to interrupt. You say there, Jim, about allowable minus allowable expenses. Now that includes your management fees and things for an agent.
There's a huge amount of allowable expenses you can get. So you don't actually need. It doesn't need to cost you to have an allowable expense. And it sounds a bit daft, but if you're self-managing, okay, or even if you're not self-managing, if you're actually having to visit your buy-to-lets and you've got a managing agent doing it for you, but you're having to nip up your buy-to-lets now and again because you do maintenance for it, okay, the cost of you doing the maintenance, in other words, the materials and also the travel. You could charge your travel as a tax deduction at 45 pence a mile because that's the rate from the inland revenue. So you can charge it at 45 pence a mile. So if it takes you 10 miles and 10 miles, 20 miles, you can put that as a deduction. So 20 times 0.45, you've got £9 of deduction. Now, if you do that 50 weeks of the year or 52 weeks, then it's 468. So when you calculate your tax and then you're having to do that, every week because you were doing something on the property over a period of time because you were doing the maintenance, you've got your materials you're able to deduct, which is understandable. You deduct that against your normal bank account, but these are costs you probably have on your own car because you won't be buying a car for this. It's on your own car. So once you've calculated your profit for tax, then you calculate you take off the 468 off that profit for tax, then that's your taxable profit. See what I mean?
Yeah.
You don't actually, the 468 isn't something you spend or anything else. It's just probably your own personal income that you're using. If you're having to use a mobile phone because it's specifically for your property business and it's wholly exclusively for your property business, you can deduct that as well against your profits of your property business because it's for your property business before it's taxable. So, or if you're using your personal phone, there's a certain allowance you can deduct as well. So, for example, if you're using your personal phone for your property business, and you're maybe using, you can assess maybe you're using it 20% of the time. So your total bill for the year is maybe £20 a month. So your total bill for the year is 20 quid a month, 240, 10%, you're 24 quid, and it's no much. But if you've only got one buy to let and you're using 20% of the time and it's 24 quid, it's 24 quid, it's no taxable anymore. So you see how the 468 and then the 24 quid, and then, you know, the next minute you're at £1,000 off. And if you've only got one property and this is what you're having to do, then effectively you're going to be arguing the case that even though you made £1,000 in profit, none of that's taxable.
Yeah.
Because the extras that you've had to put in your own pocket is proportionate part of your own personal use, which is allocated to the company, to the entity of the buy-to-let. You can argue successfully that these were having to be allowable expenses against you doing your job. So I did that. I did that in the early days before I had everything exclusively for there. I was able to deduct certain amounts against it. I've also got, you know, for one of my property businesses, I've got consultancy fees. I deduct because I'm not exclusively wholly for that business, and I don't. I just consult with that business. So I'm a consultant. That's it in a nutshell. So there's other ways to do that which are wholly and exclusively deductible, I would say. But again, speak to an accountant. It's just because, don't take my word for it. Go and check, like what I said before, because the last thing you want to do is start deducting stuff without any prior knowledge about what you're actually doing, and then the Inland Revenue turns around to you in about 6 years. Actually, the Inland Revenue could turn around to you in 30 years' time. They could turn around to you in 30 years' time. And what happens is the 6-year rule. So if they find something inaccurate in your accounts over the previous 6 years, they can then take that point, say it was in year 5, they can go back 6 years from year 5, so they're now back 11 years. If they find something in year 10, they can go back 6 years from there, so they're going back 16 years now. So the next minute, you're nailed for 30 years of tax.
That's
evasion. Yeah, tax evasion.
Yeah.
That's
not a position you want to end up in.
Yeah. I was going to say tax avoidance, but it's not. They could class that as tax evasion, that you deliberately did that. So that's the one thing. I was always taught as an accountant, ignorance of the law is no excuse when it comes to HMRC. And never mess with the Inland Revenue. They've got more powers than the police. Or, sorry, the Customs and Excise. Inland Revenue don't, but the Customs and Excise have more powers than the police. That's the people that used to beat up the bootleggers and the smugglers. Way back in the 1500s. You used to basically get clubs and kill them for smuggling booze and stuff into the country. That's the Customs and Excise. They've still got all these powers today, by the way. I know they don't use them.
No clubbing people with death, but yeah.
But that's the kind of thing you used to do in the 1300s. You know, when the Customs and Excise, or whenever it started, whenever they were, that's the type of things they used to do. They used to basically just kill people, and that was it. More powers than the police. Wow. Anyway, on a TV note.
Yeah. So obviously, income tax. I mean, if you also have income from another source, like obviously your work, savings, investments, etc., you include everything in your tax return, and anything already paid, for example, obviously PAYE, is automatically deducted.
Yeah.
And unlike PAYE, tax for rental income isn't due until 9 months after the tax year ends each April. So you could set money aside to earn interest until January 31st, payment deadline.
If you're savvy enough, you can use that money to reinvest in property with the prospect that you know you're going to make the money to pay your tax bill by the month 9 anyway, or whenever it is. If you're in a limited company, it's a different scenario, I think. It probably is month 9 there. But if you're in your own name, yes, you're on the 31st of January payment deadline for the following year. So if your tax year in your own name is the end of, it's the 5th of April. So it's the 5th of April. Everybody says the 31st of March, but it's 5th of April. That's the tax year end, and you're allowed from that tax bill. You have to pay your final tax bill and tell the Inland Revenue how much your calculation is by the 31st of January the following year. Now, if you want the tax man to calculate your tax bill for you and you can submit your details before then. I think it's before September of the same year, and the Inland Revenue will calculate your tax bill for you. So you don't need to get an accountant to calculate your tax if you want to submit it early. And they calculate your tax bill for you, and if you submit all the numbers to them, and they do that and send it back and say that's what you're due. If you go beyond that, you have to get somebody, you have to submit it and calculate it for them and do the work for them, or you can get an accountant to do it for you as well. Instantly enough, somebody says buy-to-let dead at the minute. It's not. Buy-to-let's not dead at all. Buy-to-let's still going very, very strong.
Yeah.
You may think it's dead because that's the impression that people give. And I'm happy for them to give that.
Coverage and things.
Yeah. I'm happy for people to say that buy-to-let's dead. So go about saying that to everybody. Put everybody off, because it makes me more valuable to the governments. It makes me more valuable because I've got more stock. Therefore, everybody else is selling. And if I'm the only kid on the block, how much power do you think I've got?
Yeah.
That's why. So it's the people that stay here for the longer. I've seen it come and go before, all the time. You know, when they did landlord registration, everybody says, "Oh no, it's going to all be over. Landlord registration, we're all going to be taken to task. We're all going to be struck off the register. They don't want us. They hate us." Does that sound a familiar story?
Yeah.
It's exactly the same as what's happening now. It's like, I've been here before. It's just another day. It's a new day. It's a new dawn. There's a song there somewhere, a new day, new dawn. And I'm feeling good. That's what it is. Yeah, I'm feeling good.
Is that tickle you, Jimmy?
Yeah, I'm actually feeling good because it's true. It's buy-to-let is still going strong. Definitely. You recommend an accountant that would do the tax. I use Patterson Boyd in Leven and Fife and Glenrothes there as well.
Glenrothes, yeah.
Now, I'll be honest, you know, in terms of Patterson Boyd, they don't know too much about buy-to-let. There's very, very rarely do any accountants know, because it is not a specific specialist subject for anyone in particular. So it's very rare to get somebody that's like that. But the amount of knowledge and the amount of expertise I've probably imparted on them about what I know and what they don't know means that they're probably up to speed to a degree. I would say, because there's the scenarios I run them through all the time. What if I did this? How would the tax end up at the end of the year? What if I did that? How would my tax bill end up at the end of the year? What if I did, if I moved this and I moved that and I paid from here and I did from here? How would the tax bill end up at the end of the year? Now, this is right universally across the whole equation. The key here is you don't really avoid. Now, this is where people don't understand this. Ultimately, a wealthy person doesn't avoid paying tax at all. Okay, they individually might avoid paying little. They might pay little tax, which is what they're after. But overall, with the assets they own, they pay almost just the same amount of tax.
Yeah,
because they're not taking it out of the limited company. Therefore, the limited company's having to pay the tax on it, on the income. And that's the thing. So this impression that wealthy people pay no tax and it's not fair is not accurate. Is not an accurate reflection of what actually happens. It's they pay the tax, but they pay it through their limited corporate companies. That's how they pay it. So I'll pay. I must pay about well over 100 and 200,000 in tax or something like that.
Yeah.
But I don't pay. I pay hardly anything in my own name. Because the reality is, I don't want to pay tax in my own name, because it means that money I'm getting taxed on, I'm going to want to reinvest back into my company. So I'm going to get taxed on it, and then I'm going to have to put it back in. Well, why don't I just leave it in the company and it gets taxed at a lower rate than I would? Because I get taxed at a higher rate, because it's a long term, it's a long game for me. So you leave it in the company, and the company get taxed at the corporate rate, which is now 25%.
Yeah.
But if it comes out and goes into your name and you're taking it as PAYE, you get taxed at 40% if you're taking out a lot. Or if you otherwise take it out as dividends, you can get taxed at, I think it's 8.75% with no national insurance contributions. That's a good way to do it. However, you still have to pay 25% corporation tax on that dividend. But you don't pay it. The company pays it. Because the dividends are deductible against their income, against their profits. So if the company makes 100,000, okay, you can take out 100,000 and be taxed at the 40% on probably 60 grand.
Yeah.
Or you can be taxed at 25% on the 100,000, and then you can take the 100,000 out of dividend and get taxed at 8.75. If you go over a certain amount in dividends, by the way, you get taxed at 33%. So you don't want to go too high. But then you could also pay money into your pension to bring that taxation liability down to basic rate again. Again, that's another thing. And we've got other tax shows on that. It tells you how to do that.
We've covered that. And I think with income tax there, just to finish, obviously, the key is to minimise your bill and claiming back every last allowable expense. So make sure you keep all those receipts, or like Jim says, keep it all in the one bank account separately if you've got the limited company, and it makes it all nice and neat and easy to transfer and hand to your account. But let's move on to, did you have a question coming through there, Jim, you wanted to cover?
I've got lenders are killing on stress tests, and yeah, quite rightly so. I mean, why would they not want to stress test you? Why would you not want to stress test yourself? I stress test myself all the time. I stress test myself at 14%. So when I go into a deal, I know exactly I'm going to be able to weather any storm going, because I'm stress testing at about 14% at some point.
Don't stress test you, it could leave you over.
Yeah. And this is called risk analysis and sensitivity analysis about how things change. If you change certain criteria, like the occupancy rate, like the interest rate, like the rental value, the rental level, then how will that come out in the bottom line? And what tolerances have you got before you actually break even? That's what stress testing is all about. So I stress test even more than the bank stress tested. Interesting enough, you said about the EPC regs will kill it as well. I don't think the EPC regs will kill it at all. I actually think they'll not be as damning as possible on it. You know what I mean? They'll not be draconian about the whole thing. It's like a lot of people will have to comply with the EPC regs, and I think I've seen it all before. You know, it's like, we'll either get there and they'll kick the can down the road and say it's no possible to get everybody to comply at the same time, so we can't police it, or we can't police it and we're just going to say, look, you know, please do it when you need to do it, and if we do catch you, look, could you just get it done?
Yeah, I think it's going to be a really difficult thing to police and get people to that level. But I mean, some properties it's easy to get to that level, others not so much. So we'll see how that goes. And like you say, Jim, it might get kicked. The can might get kicked down the road.
Interest-only mortgages coming at the end of the term. Yes, you probably will remortgage again anyway, and just go into another deal. Speak to your lender, existing lender about it. Speak to your mortgage broker about it. More than likely, I think you can get mortgages in your own name up to about 85-year-old. I think you should get them beyond death, to be honest, because the reality is for a lender,
the right setup.
Aye, if you've not got any liability, and if you've not got any risk involved in the mortgage, then why would you bother if the person's going to die early? You know, and I don't mean it in a nasty sense. I mean, you know, as a bank, it's like, you know, oh, we're only doing it up to 85 in case you kick the bucket before then, and or at that time, because that's the average age. Well, why not just do it to 100? You know, your mortgage, because if you go by 85, you've probably worked it out. You're going to have a huge amount of equity in the deal anyway, which is about 60% loan to value. So as a mortgage holder, it's like, what risk are you taking? The person passes away, the probate goes in, and you get your money because you've got a first charge on the property. Why would you bother? There's no risk.
Yeah, that's true.
So that's where I think it is. Like, let's move on to capital gains tax.
Yeah, capital gains tax. So, unlike selling your personal property, whenever you sell a rental property as a private landlord, you pay capital gains tax on the profit. There are recent and upcoming changes to how this gets calculated. So let's have a look at them, Jim.
Yeah.
So the annual personal capital gains tax allowance from April 2023 is 6,000. Down from the previous 12,000. We've covered that a few times. And
so can I just quickly cover about the annual personal allowance is 6,000 now? If you're married and you have a spouse, you can both have £6,000. So at this point in time, if you've got one property, you're thinking, I need to transfer it because I've got a limited company now. So when I first started, all of it was in our own names. And then I got to a point where it was like, we were going to be higher rate taxpayers now. So I went, I'm going to need to form a limited company. So I started buying all the properties in my limited company from then on to hedge everything. So I was only paying corporation tax on it. And lo and behold, you know, it was a great idea because obviously it came along and all the changes happened. And I went, oh, I've got a limited company already. But the key here is you can still transfer some of your properties you'll have to pay 6% ADS, but you'll still get the capital gains allowance if you've got a capital gains on it, because you'll get £6,000 in your name, and you get £6,000 in your spouse's name. So you'll get 12,000 overall. Now, I was using the 12,000 in both our names over the last 3 or 4 years to transfer a lot of properties into my limited companies without having to pay capital gains, because I was getting the generous allowances. Plus, I was using the 6 at a time to avoid ADS as well. So that was my strategy, and now that's gone now. So that next year, I think it's going to go down to 3,000.
But in April 2024, the personal allowance will reduce to 3,000.
We talked about this, didn't we? Now, if anybody had caught our show back in 2020, was that? Or 2019? Yeah, we talked about the budget of office responsibility, identified that capital gains, if it was the allowance, taking away the allowance and actually reducing it, would bring 18 billion in extra tax revenue into the exchequer. And that's why they would do it. So you need to start doing that strategy now. And that's when I started, for that very reason, because I knew the writing was on the wall and it was coming. So if you were lucky enough to listen to our shows all these years ago and actually took heed of that, which is very few people actually do this. It's like when I phoned everybody about and says, buy stock in this company, buy stock in this company. There was one person, about 100 people I phoned, that bought stock in that company, and I made 60 grand in 3 months.
Good.
Yeah. And he made about 20,000 in 3 months as well. And I phoned him up and says, I'm now selling. And he went, okay, I'm selling as well. and yet 99 other people didn't bother. And it's like, oh my God, you missed the boat.
You should have listened.
Really? Yeah, should have listened. That's what bought my place in Spain.
Good.
Paid for my furniture as well. Anyway, apart from that, yes, PIN. Cheers, Jim. I'll catch you at the PIN on Thursday. I am at the PIN meeting, which is the Property Investors Network. It probably is the only one time I will ever appear on anybody else's stage ever. I'm not remotely interested. Lindsay caught me at a really good time, vulnerable time probably, and said, how would you like to come along and speak on the PIN stage, the Property Investors stage in Edinburgh? And I went, okay, then, throw myself out of my comfort zone, go and talk on somebody else's stage. And so I'll be appearing at the PIN, on this Thursday coming. The Thursday, Thursday coming.
Thursday coming, yeah,
Thursday coming. I'll be teaching people. I'll be teaching. I'm not lecturing. There'll be a wee bit of talking about what my track record and all the rest of it, and where I am and what everybody's doing. But I'll more than likely be teaching for the 45 minutes. Yeah. So this is a session that people will probably charge you £1,000 for, and I'm going to be doing it for free. I'm going to be doing it for free. 45 minutes of my time. And I'm joining. You're coming along with me, Richard, as well.
Yeah, I'm coming,
So that's at the PIN, at the Edinburgh PIN. So just look that up. Lindsay Yule, Edinburgh PIN, and part of Simon Ducey's Investors Network, Property Investors Network. Anyway, let's go back to this capital gains. Down to 3,000 next year. You can set numerator expenses. I think you said, Richard, your capital gains bill when you sell, including buying and selling costs, like the stamp duty, the legal fees, the estate agent's commission, as well as improvements that weren't claimed as repairs. That's improvements like, for example, in the early days, it used to be for example, if you put a shower over a bath and the shower was never there before, and the shower cost you £2,000 to install over the bath, I know it's a big amount, and you would buy, what, £2,000? You might actually wet wall it. So you might end up wet walling it and all the rest of it. That might be how it costs £2,000. That £2,000 technically is a capital improvement. It's not a revenue expense that you can deduct straight away. Inland Revenue's never going to find it if you do deduct it straight away. they're like, oh, they've taken that off. It's like, how are they going to know? But this is the thing about if they do an investigation, it opens a can of worms, and
it could lead back.
That's why you've got to be whiter than white when you get into this, and make sure ignorance of the law is no excuse. Remember, so that technically, because it's new, is a capital improvement. If it's a revenue expense is where you trade like for like. For example, I've got a kitchen, I'm going to rip it out, I'm going to put a new kitchen in. It's going to be more or less the same type of kitchen. Then that is a revenue expense, deductible straight away. That's the difference. So revenue expense, like for like, changing over. Capital expense, you're putting something there for the first time, except when it comes to double glazing.
Single glazing, double glazing.
Single glazing, double glazing with single glazing with double glazing, that's still a revenue expense. So if you're wanting to mitigate your tax by the end of the tax year, because you've now worked out your tax bill in February, it's going to be coming at the end of the tax year, and you're thinking to yourself, wait a minute, I need to bring my tax bill down a bit. I'm going to bring some of my scheduled improvements or my scheduled repairs and improvements forward and start doing them earlier in this tax year in order to bring my tax down to maybe the lower rate threshold. This is the key. See, I'm doing this. I've worked out now that this is just going to push me to a higher rate. I'm either going to put a personal contribution to my pension to bring me back to the lower rate tax, or I'm going to bring forward some repairs and improvements that I'm going to do in this tax year in order to bring that down to the lower rate when it works out overall. And then it smooths it out, so I'm paying lower rate tax every single year in terms of my landing. That's a way to do it. And capital gains, then it won't apply to capital gains. It will apply to your normal day-to-day profits.
Yeah, that's good. And the thing about capital gains as well is, well, the useful thing is capital gains rules are the same in England, Scotland, Wales. So for portfolios that cover, maybe if you do have property that's maybe all over the country, then you could apply the same calculations and things to your capital gains.
Yeah, it's a universal thing. Corporation tax. Let's talk about corporation tax.
Let's finish.
Tax. Yeah, corporation tax is brilliant. Limited companies float my boat right now, especially when it comes to moving money. That's all I'm going to say, and it's perfectly legal.
Yeah. Okay. Well, unlike private landlords, then, who pay income tax and capital gains tax and things, limited companies pay corporation tax, which covers both rental income and profits from selling assets. So the changes in corporation tax in April 2023, which was this year, mean that companies now pay a gradually higher rate depending on how much they earn using different tiers, Jim. So explain that to us.
Okay, so profits up to 50,000, you pay corporation tax at the small profits rate of 19% still. So if you're in up to 50,000, you're still there. Now, I could hear most of the buy-to-let people out there, and even everybody run their own companies, going, wait a minute, I'll just start another limited company. Unfortunately, that doesn't work. They pull everything together. So if you've got one limited company earning up to £50,000, you're paying 19%. You think you could start another company in your own name, 19%. That's pulled in under the small companies rules, and therefore you're pulled together. You're paying 25%, or the marginal rate in between. So it gets pulled together, a bit like the rates system. So if you own several properties in your own name in terms of commercial properties, you're pulled together for the rates total rather than actually just the individuals. Because you've got, I'll be getting away with small business rates relief on every single property. No, you won't, because they're all in your name. So it's pulled together as one, and you'll pay on the big amount. So if your rates amount ends up being £30,000, you'll be paying rates on every single property. How do I know that? Because I fell foul of that when I first started.
I've been there, done that.
It's like, God, why did I do that? It's like I should have spoke to somebody beforehand. But there was nobody out there at that time to tell me that was the rules. So that's the rules in terms of corporation tax. You if you're under £50,000, you'll get away with up to 19%. You'll get 19% corporation tax. If you've got several limited companies, they'll be put together, and that'll be assessed on the total amount in terms of profits. So the next
it was over 50 then
to 250,000 initially attracts 25%, but it can be reduced with marginal relief. And we've put a link again. Apologies to the people, you can't get it on TikTok, you can't get it on Instagram, because we're streaming live on these channels and they don't allow all that content on there. Go to our YouTube channel, just go to our website page. If you go to our homepage on our website, down in the blog, you click on that, it will be there, the blog for this show itself. This will be on here again. The podcast will be on here for this as well. But all the detail we're discussing here, all the script that we've got right here, this is all this that we've done, all the script so far. You won't obviously get my personal knowledge in here because it's only a 4-minute read. But the basic fundamental details, there is a link to the marginal relief system for the HMRC on that post itself on our website. in the blog.
Yeah.
So there's a marginal relief, and then profits exceeding 250,000 pay corporation tax at 25%. This is what I'm talking about. So if you've got 5 individual companies earning 50,000 in profit each, you'll be taxed at 25% on every single one of them, with no small rate relief, and there'll no be marginal rate relief either. It'll be 25% on the whole shooting match, right across the board. So there's a lot involved in owning a company with corporation tax. There's also VAT returns. But you don't necessarily VAT, and right, private residential renting does not attract VAT at all. You don't get a deduction for VAT either. So don't kid yourself if you think you've got a company that runs commercially as a maybe selling widgets, but it owns residential property. Don't try and kid yourself and try and claim the VAT on stuff that you're doing for residential property against your normal mainstream selling widgets, because it's tax evasion. And remember, the customs and excise are the people that have the VAT. And remember what I said in the beginning about what the customs and excise used to do. Called me to death for being a smuggler. So that's the type of things the VAT man will get you for. But there is a threshold, remember. I mean, I've got consultancy with my limited company, one of my limited companies, and I have and they own residential property, but my consultancy fees are less than the VAT threshold. Therefore, I don't get charged, and I don't take VAT on anything for that reason. I don't want to get charged VAT. It's like if you get charged VAT, then you're in the realms of, God, another return, another unpaid tax collector system to run for the HMRC. So we do run VAT in some of the other companies because obviously we're selling widgets. But some of the other companies I own they're not VATable at all for that very reason, because they don't qualify to be VAT registered. And also there's also annual accounts to do. So unless you really love paperwork and know the tax law inside out, we do recommend hiring an accountant to manage these for you. But as I said before, we'll come back to saying the basic day-to-day stuff that you do with your company can actually just be put in a spreadsheet or downloaded from your bank online, because they know that. They could be straight downloaded into QuickBooks or into Sage. I mean, I started off in the very beginning with Sage Instant Accounting. So in the very beginning, I started off with Sage Instant Accounting. It was basically £100 to buy it for the year. It was not a constant one all the time. It was just Sage Instant Accounting. You had on one laptop. So I used to use that all the time, and I just used to take my bank statements and I used to process them. I used to just put all the transactions from my bank statement into Sage. But the great thing about that is when I hit a button, it told me my profit and loss, and it told me my balance sheet, and it told me my trial balance as well. I didn't need to do anything else. It was brilliant. And then I was able to send that to my accountant, and they would do the return for the tax and that at the end of the year, and it was minimal charge from them because they're not doing the day-to-day numpty stuff, which I'm doing.
Yeah.
Now I've got to the point where I've got Sage like 50, which is multi-company structure, and several, people. I've got a bookkeeper. I've got 2 bookkeepers as well as myself, and we operate that on a remote basis. So they're virtual assistants. One lives at the other side of Fife, and one lives over the other side of the West Coast. And we go online and we do all the transactions individually ourselves that we need to do, and that updates all in real time because it's a multi-company structure. And we can choose one of the 6 or 7 different companies we've got and just go into that individually at the same time and work on the accounts. So that's where I am right now. So I started off in the very beginning with that, and then now I'm at a multi-company structure. And there's other ones. There's QuickBooks. There's Xero. There's loads of ones out there that you can get.
Marcus is saying Xero there.
So, but more importantly, speak to a really good accountant on what they're doing and how they're doing it.
Yeah, and I think that is a really important thing when it comes to tax, and is to have a really good accountant involved. But like you say, Jim, to do things as you go as well saves you all that hassle at the end of the year you get these people who run about and trying to get everything together. And it's just, you don't need to be in that position if you do things kind of methodically as you go throughout the year. Yeah.
And that's us. I think that's the end of it.
That is us. And I think for me, staying on top of your tax rules and lettings law and things, and the performance of your property is really an essential part of being a landlord and an investor. If you love the show today, please reach out to me if you've got any questions. my contact details are in the blog that's attached to the
And for the
show
people on
today.
TikTok or Instagram, it's Richard Cook at fifeproperties.co.uk.
Yeah.
So Richard.cook at fifeproperties.co.uk.
.co.uk, yeah.
Or you can just call you direct at probably any of us if you put an inquiry in, ideally. And that's it.
I've stuck my mobile number in the blog as well.
Yeah. Okay.
All right, guys. That was brilliant. Thanks for all your insights into tax, Jim, because I know people get a wee bit daunted by it, but that was good to hear. I know you do. I know. And thanks for everyone for your interactions this morning. And that's us. So I'll let you all go. Right,
see you later, guys. Bye-bye.
Bye.